Three crashes, three different causes, but in all three, the same thing happened. Sellers could not find buyers. Exits disappeared. Stop losses became suggestions. Price gapped through levels that could not break. The entry worked. The exit did not exist. Greed and fear changes customs, but liquidity behaves the same way every time. Today, we answer the question that makes everything else real. Can you actually execute your plan? Think in odds, act with discipline. Let's begin. The IMF defines market liquidity as the ability to rapidly buy or sell a sizable volume of securities at a low cost and with a limited price impact. One sentence. 5 hidden dimensions. Dimension 1. Tightness. The bid-ask spread. The gap between what buyers offer and sellers demand. For an Apple stock, the spread is typically 1 cent on a $190 price. That's 0.005%. Invisible. For a small cap trading 50,000 shares a day, the spread might be 20 cents on a $10 price. That's 2% in, 2% out. 4% gone even before the trade moves. Dimension 2. Depth. How many shares sit at each price level? A market can look liquid at the current price while having massive gaps below. These air pockets turn corrections into crashes. Dimension 3. Immediacy. How fast can execution happen? Market orders execute instantly at uncertain prices. Limit orders control price but sacrifices certainty. Speed versus control, the fundamental trade-off. Dimension 4. Resiliency. How quickly do prices recover after a shock? Some markets heal in minutes, others stay broke for months. Dimension 5. Breadth. How many participants are actively trading? A market with 10 large players is fragile. If 2 step back, liquidity collapses. A market with thousands of participants absorbs shocks. Breadth is resilience through diversity. These 5 dimensions determine whether a trade exists in reality or only in theory. March 2000. The Nasdaq peaks at 5,048. Companies with no revenue trade at extraordinary valuations. The future has arrived, and everyone wants a piece. Then the bubble pops. Over the next 2.5 years, the Nasdaq drops 78%. $5 trillion in market value evaporates. But the price charts don't show the real story. Many technology stocks did not just decline, they became untradeable. Stocks that traded millions of shares daily saw volume collapse by 90% or more. Bid-ask spreads exploded. Traders who thought they could wait for a bounce discovered there were no buyers at any price. The stocks did not crash to zero in one day. They bled out slowly because nobody would bid. Here is what that looked like in practice. A trader holds a technology stock at $80. It drops to $60. I'll wait for a bounce to sell. It drops to $40. It's oversold, has to bounce. At $20, the trader finally tries to exit. But the daily volume that was 2 million shares is now 50,000. The spread that was 5 cents is now $2. The market order fills at 17, not even 20. The liquidity that existed at $80 does not exist at 20. This is the cruel mathematics of liquidity. It disappears fastest in the names that need it most. The lesson from 2000. In a speculation collapse, liquidity drains from the most extended names first. The stocks that went up the most become impossible to exit. Greed creates the setup. Vanishing liquidity delivers the punishment. September 2008. Lehman Brothers files for bankruptcy. 158 years of history. $639 billion in assets. Gone. But Lehman wasn't the disease. It was a symptom. The real crisis was contagion. It started in housing. Mortgages given to borrowers who could not pay. Those mortgages packaged into securities. Those securities rated as safe. Those safe securities held by everyone. When the mortgages defaulted, the contagion spread. Banks stopped lending to each other. The gap between treasury rates and interbank lending spiked from 100 basis points to over 450. Banks did not trust banks. Commercial paper markets froze. Investment-grade companies, GE, McDonald's, could not even roll over short-term debt. Money market funds broke the buck. The reserve primary fund fell below $1 per share. Think about that. Money market funds, the safest, most liquid instruments retail investors use, became illiquid overnight. For stock traders, the experience was visceral. Bid-ask spreads on large-cap stocks widened dramatically. The VIX hit 80, the highest reading in history. But the VIX wasn't the problem. The problem was what happens when VIX hit 80. Market makers pull back. Depth evaporates. The order book thins to nothing. Stocks gap down through stop losses. Limit orders sat unfilled. Traders who were hedged found their hedges could not even execute. The lesson from 2008, liquidity crises are contagious. They start in one corner of the market and spread everywhere. When fear reaches extreme levels, all correlations go to one. Everything sells together. Diversification fails temporarily. Greed built the leverage. Fear triggered the unwind. Absent liquidity made it catastrophic. March 2020, a virus emerges. Within weeks, the global economy shuts down. The S&P 500 drops 34% in 23 trading days, the fastest bear market in history. Unlike 2000, this wasn't about valuation excess. Unlike 2008, this wasn't about financial engineering. This was pure uncertainty. Nobody knew how bad it would get, and in uncertainty, the instinct is to sell everything. Liquidity conditions deteriorated faster than any previous crash. Modern markets are more interconnected, more algorithmic, more reactive. When everyone hits sell at the same moment, the machines amplify it. ETF arbitrage broke down. Bond ETFs traded at 5% discounts to their net asset values. The mechanism that keeps prices aligned failed. Treasury markets, the foundation of global finance, seized. Bid-ask spreads on 10-year treasuries reached 6 times normal levels. The safest asset on earth could not trade properly. The Fed intervened with $775 billion of treasury purchases in 2 weeks. Compare that to $80 billion per month during QE3, nearly 10 times the pace, because the market needed that much liquidity injected just to function. For retail traders, the impact was severe. Stop losses gapped through. Market orders fell 3, 5, even 10% away from expected prices. Some brokers restricted trading on certain instruments. The lesson from 2020. Speed has changed. Modern markets can seize in days, not weeks. And when fear is universal, when everyone needs to sell at once, even the safest assets become illiquid. The virus was the trigger. Fear was the accelerant. Absent liquidity was the damage. 3 crashes: technology, housing, and a virus. Completely different causes, but the liquidity pattern was identical. Phase 1. Confidence builds, spreads tighten, volume increases, everything feels liquid. Phase 2. A crack appears. Early sellers get out easily. Liquidity still present. Phase 3. The crack widens. More sellers emerge. Market makers start pulling back. Spreads widen, depth thins. Phase 4. The rush for the exit. Everyone sells at once. Buyers vanish. Prices gap. Stops fail. Phase 5. The bottom. Liquidity is worst precisely when prices are best. Those with cash cannot deploy it efficiently. Those without cash cannot exit. This sequence repeats because it's driven by human behavior, not market mechanics. Greed compresses risk premiums and encourages leverage during good times. Fear triggers simultaneous selling during bad times. And liquidity, which depends on the willingness of others to take the other side, evaporates when that willingness disappears. The customs change, the behavior does not. Here is the system. Before every trade, 4 gates must be passed. Gate 1. Can you enter? Check average daily volume. Minimum 500,000 shares for day trading. 100,000 for swing trading. Check the spread. Above 0.5% is a red flag. Gate 2. Can you exit? If the position needs to be liquidated tomorrow, how many days would it take at 1% of daily volume? What's the worst case spread if volatility doubles? Size for the exit, not the entry. Gate 3. Can you manage risk? Will the stop loss execute within acceptable slippage? Does the instrument have enough depth to observe the stop? In March 2020, many stops triggered 5 to 10% below their set prices. That's not risk management, that's hoping. Gate 4. Does the math still work? After realistic slippage, is expected value still positive? If round-trip friction exceeds 25% of expected profit, the edge is being consumed. If any gate fails, the trade does not exist. Position sizing must respect liquidity constraints. Trades exceeding 5% of average daily volume face significant market impact. Conservative sizing stays below 1 to 2%. For a $100,000 account trading a $50 stock with 200,000 shares daily volume, 1% of volume allows 2,000 shares. That's $100,000. The liquidity math works here. For a $1 million account, that same stock limits the position to $100,000, only 10% of capital. As accounts grow, liquidity forces portfolio changes. This is why large funds cannot trade small caps. Not preference, physics. Slippage budgeting protects expected value. Budget 0.05 to 0.1% for large caps, 0.2 to 0.5% for mid caps, 0.5 to 2% for small caps. Slippage does not show in back tests, it shows in P&L. Sometimes the best trade is no trade. Hard pass on any stock with daily volume below 50,000 shares, spreads above 1%, position size exceeding 5% of daily volume. Avoid holding through earnings announcements with full position size, Fed meetings, index rebalancing days. These aren't suggestions. They are rules that separate systematic traders from gamblers. The market does not own anyone an exit. Liquidity is permission, not a right. Liquidity is the market's permission to execute ideas. Position sizing tells how much to trade. Liquidity tells how much can actually be traded. Stop losses define intended risk. Liquidity determines real risk. In our foundation series, we have built the complete framework. How much can you lose? The 1% rule. How much should you bet? Position sizing. Is the bet worth taking? Expected value. How do conditions change? Volatility. And now, can you actually execute? Liquidity. This is the foundation. Everything that follows builds on these 5 principles. The traders who survived 2000, 2008, and 2020 share one characteristic. They respected the market's power to refuse their orders. They sized for the exit, not the entry. They traded where the market led them. Greed and fear will always exist. They will always find new costumes. .com, housing, virus, AI, something else, always. The trader who survives isn't the one who predicts what comes next. It is the one who positioned to handle whatever comes. That's the difference between theoretical edge and realized profit. Think in odds. Act with discipline. See you in the next one.